Connect with Neeraj Deewan, who's joining in on the show. Neeraj, hi there. Good morning. Starting off by just maybe getting in your thoughts as well on the kind of commentary that has been made, or the kind of reveal due to the SEBI study with respect to the fact that nearly 54% of the allotted IPO shares, this is excluding the anchor investors, are sold in just a week. And they're talking about how we need to be a good doctor to companies. Don't prescribe steroids, they say, when paracetamol will suffice. Just wanted to get in your thoughts on the study reveal.
Yeah, good morning. Yeah, actually, there's so much of paper availability, and money, flow has to be rotated. So I think one issue gets over, other one is already down the pipeline. So I think that is why this rotation has been happening by retail investors. They sell one and then invest the money in the other IPO. So I think that's what's happening. Though, of course, one needs to now, we reached a stage where valuations are really getting stretched as far as some IPOs are concerned. So once you're investing in an IPO, of course, once should take an advice of the financial advisor and invest in good company. Then you should, investment is always made and wealth is always created when you hold on for a longer time. So keeping that in mind, if one gets an entry into an IPO stock which has a good potential, it's always better rather than churning every week to hold on to the stocks and make that wealth which is generated over period.
Okay, fair enough. That's the view coming in. But let's also get in your take then as to how you're looking at the overall markets. And in particular, just wanted to get in your thoughts on the fact that we've been seeing the streak of consolidation continuing into the broader markets. And although we continue to hit record highs on the frontline index, that undertone of consolidation is very evident. Do you think that it's only going to continue?
Yeah, we've seen there have been periods of consolidation, whether it's sector-wise or whether it's market-wide. And then we've seen, there has been, if anyone has bought the dip or bought in the consolidation, he's been rewarded so far. So rather than waiting for correction, a big correction, one should look at valuation. Then if you're getting your stocks at decent valuation, even in small dips, one, looking at the long-term perspective, can invest into them. Though if we've been all waiting for corrections, the kind of market rally that we've seen has been tremendous over the last, at least this year, if you see, right from April till now only, we got such a good return in most of the investors' portfolios. In just about 4 5 months, people are sitting on 30, 40, 50% kind of return on portfolios, which we not seen earlier. So definitely seeing this kind of a rally, one gets little cautious, little careful. But if you are into the right stocks, you should stay invested and use opportunities to invest more. But I'm saying that valuations are very important. So we should not just be investing in stock at any multiple. And we as experts have also learned over the last 2 3 years. Earlier those multiples of 30, 40, 50 times was only reserved to certain category of sectors like FMCG or a certain high growth IT companies, large cap IT companies, pharma companies, but now there are new sectors which are emerging. So one needs to be wary of the new sectors and invest in those sectors also, even though the multiples may look high for the shorter term. But if you study the long-term perspective and the kind of opportunity that is there, then one can even invest in those stocks based on the long-term perspective.
Makes sense. So, Neeraj, the obvious question then is, where is it that you're finding that valuation comfort, wherein either you'd look to add more positions or even buy afresh?
Basically, one is always looking for ideas. In the market, now that market, after seeing this kind of a rally, is becoming more and more stock specific. I think now is the time when you have to be really careful picking your stocks. So they are different. Like defense, we were all talking about stretch valuation just about a month back, and we saw a good correction also happening in some of those stocks. Then today, I'm just taking examples. I'm not saying that I'm recommending these stocks. I'm just taking examples. Like today, the HAL news came, so which is giving another, strong order visibility for HAL for the next few years. So again, there'll be upgrades for the stock. So one way of doing it is that you like the sector, whether it's EMS is one sector where you got so much happening with repeat orders coming and new clients being added for those EMS companies. that there also there's huge potential. So they are also going through a learning curve where they get orders from a company, they do it well, then they get repeat orders. Other companies also come and give them orders. So they're also, and to put in the capacity for an EMS company is not that big a challenge. So once they've the technology is set and once they know what they're doing, they can add capacity. So I'm just taking examples of sectors where valuations are high, but still there's potential of getting re-rated from these levels also. So whenever you get corrections based on market noise because of high valuations, even in these high value sectors, so I think one should look at those opportunities.
All right, stay with us.
What is happening largely to the entire space in terms of how the IPO flip has started. Sunil Subramaniam joins us and let's take a conversation forward. Sunil, I'm using the word consciously when I say that looks like in the SME market, it is almost like a casino now. It does not feel like a stock market.
I agree with you fully, Nikunj. I think, and this is the reason for this is also related to the whole futures and options rampant, the demat account going up. I think post-COVID, we have had these youth who have come with a lot of time on their hands, with internet and technology at their hands, who are treating the stock market like a gambling den. There's no two ways about it. And we don't have much other options for gambling. You see the similar kind of success when it comes to Dream 11 and those kind of sports related things. So I agree with you fully that this entering into IPOs, and fin influencers, despite all of SEBI's restrictions, are playing a big part because they are recovering this. And in a sense, it's like a get rich quick scheme. And so booking gains from these IPOs clearly shows their intent. They are not investors, they are speculators. So the words that you use, I think, perfectly fit the bill.
Let's understand the chain. Let's extend the chain. There is the regulator. The regulator will give approval as far as the process is clean. Regulator, Sunil, will never cross an IPO or it will never put a full stop to an IPO on valuations. That's the function of merchant banker. The regulator clearly is talking about disclosures. So somewhere do you think in this case, the merchant bankers and the brokers, they really need to be careful and they need to do the fiduciary duty of not selling bronze at the price of diamond, because those are the guys who are taking the company public?
In a way, partly I would agree with you. Because see, these merchant bankers are not saddled with the task of right selling or doing. Their job is to get a maximum price for the issuer, right? One. Second is, since stock market is like a commodity market, right? Who is to say what's the right price? Are average fees of 25 the right, average fees of 32 the right? The market is the best determinant. So I think that to put the blame on merchant bankers that they are trying to maximize the rewards for the existing shareholders, whether they are the promoters or they are the private equity people, I think it's part of the capital market. That's how capitalism works, right? Now, who is going to regulate this? Now, the point is very simple, right? I don't think even the SEC regulates this. Unless there's some price fixing, rigging, there's some false news put across, which makes the share price goes up. Unless you can find clear evidence of fraud, right? I don't think this is one. Second, let me take a slightly larger perspective, Nikunj, is that I think this is all part of a healthy capital market. It's only when you have these speculative entities like these people come in that there is liquidity in the market. But if you regulate them and take them out, overall as a market, the liquidity is going to shrink. So there's a moral issue there that maybe youth who don't know anything about the markets are coming in. They are making money today. Tomorrow they'll burn their fingers. They're going to go away from the markets. That's one social moral issue. But from a healthy capital market, there's always need for speculators. Go back to the Badla days, right? There's always an element of speculation which is necessary for the markets to breathe. So it's a healthy capital market, my perspective. But yes, people who are unaware, who are being used by fin influencers to invest in this without any basis, are looking to book gains. And you also saw the SEBI study say that when you book losses, they just fill it and you put it in their cupboard. They forget about it, right? They are very public about their profits, but they hide their losses away in the cupboard. But that's natural. I'm saying we are a developing capital market, and these things will happen. Should the regulator step in on the valuations? I don't think that's right, because there is no golden rule. right, on what should be the right valuation. The market is the best determinant. I mean, you take any other
I
commodity.
agree, sir. I agree.
Yeah.
I agree. But let's address something what could be called as the need of the hour. Now, while we may say that market is like a bidding market, it will decide what the right price is, what the wrong price is, but we are dealing with a new generation of, I would say in this case, demat owners. I'm not using the word investors purposely because I don't call them investors. They are new gen demat owners. And Neeraj, nice to see you back. I'm coming right back to you after this question. So we have about 5 crore demat owners who have become demat owners after COVID. They don't know what is right, what is wrong. They've only seen the glory of a bull market, not the downside of a bear market. Do you think somewhere here SEBI needs to come in and put an extra vigilance? For example, in order to control the market risk, the regulator and exchanges can change the margins. So if we have to prick the bubble in the SME market, which is where it is, and we are calling out a bubble, Sunil, we have to call spade a spade, the regulator can tighten. The merchant bankers need to be careful rather than saying, okay, the risk lies with the investor. Those are folks who don't understand all this, Sunil.
The danger, Nico, is that there is no orderly move from chaos into stability. Moment the regulator announces something like this, there'll be a collapse, and lots of people will have faced massive losses, and you're actually going to give them a big thappad and a big shock. So it's a very finely, I think, talking it down, like the SEBI did in the small cap case, right? Or the SEBI did in the futures and option case. You can talk down it, like Phil influencers. They tried a little bit of thing, talk it down. But putting any regulations, right, which gives the signal that SEBI says this is, what do you call it? Irrational exuberance, is that those kind of words could trigger a collapse. So I think we need a regulated move from this chaos, and it's not easy. I would suggest we start by first talking, advising, guiding before we introduce any harsh actions which could give a wrong signal to the market and lead to a domino effect. So I think that's the balance of view I think even SEBI must be carrying with them. And as far as data and analytics is concerned, SEBI has a fantastic AI team of high quality engineers who are churning these data. So if they are sensing that there is some wrong process involved, some kind of an insider trading involved, you saw that case of the Yamaha showroom dealer, right? Maybe is there something there that some information was leaked, something was there, some operators were playing, then they should take harsh action, right? So wherever there's a ghair kanuni thing, they say, no, then you take step action. But I would step away from trying to regulate a free capital market through regulations, but talking is always welcome.
All right, Sunil, so nice to have you back. Thank you for joining us. Neeraj, let's get a comment from you also going on this SME halabaloo. Some are calling it casino, some are calling it gambling den, some are calling it Hindi Joe Ek Adda. What's happening there?
Yeah, good morning. Yeah, definitely the kind of frenzy which is there, and we've seen these cases of small companies getting 100x, 200x, 400x kind of subscription amounts. One has to be careful, but I think what can be done, according to what I understand, is that there should be some awareness exercise which can be initiated, whether it's the regulator or whether it's the market experts, whether it's the media channels. So I think this awareness is what is important. You can't really tell someone not to invest in a stock. You have to make them aware that you have to invest in a stock based on valuation. Everything that you invest in has to be studied properly because you're putting your hard-earned money into work there. So I think awareness is what is important, and once people get aware, and once some of them will definitely burn their fingers in the process when some of these IPOs, SME IPOs, or the companies can go kaput, and all of a sudden they stop trading. So we've seen that happening earlier also, so which may happen. So some will burn their fingers, and some, based on the awareness exercise, will become aware and start investing in more high quality names rather than investing in any other second IPO which is coming.
All right. Amongst the stocks in news today, there's Aditya Birla who's going to consider some fundraising, and they'll be having a board meet, Aditya Birla Fashion, that is. And I was just curious, Neeraj, to get in your take on this entire retail space, given the kind of, ever-evolving consumer trends that we have been seeing, a lot of these companies as well adapting to it quite well. Who do you think is going to be the standout player or players within the entire space?
Actually, as far as retail play is concerned, one example, again, I'm not recommending the stock. One example is Trent, the way they have created the business model, and the way they've come out with stores, which, right now also they'll have some stores which are maturing this year, next year. So, they've been coming at and expanding and, delivering again and again. So one needs to be one needs to wait for opportunities in those kind of companies. Though the stock has gone up a lot, so I'm not really recommending at the current valuation. But, I'm just taking an example to give an idea. So like Aditya Birla Fashion also, like, if we are talking about some more restructuring happening there, capital coming in there, but we've seen the return has not really come. For one investor who's invested in Aditya Birla Finance in the last 2 years, not made the kind of money which he would have made in other companies. So retail and textile together, and which they have right now, is one which is not really that lucrative for the investors. So once they really they separate the brands and separate the retail play, I think then the real value will emerge. So I would look at companies which have specifically focusing on brands. To that is where the valuation comfort comes, and that is where you can give higher valuation also to those companies.
Okay. Kunal, you've liked the stock in the past, right? ABFRL. So Neeraj, Suzlon, Yes Bank, Vodafone. Let's talk about all three. What are your thoughts on these three stocks?
Again, to be very frank, I have not invested in these stocks recently. Neither do I intend to invest in them. There are a lot of opportunities where one can make money. And, you've seen the kind of past that these stocks have had. Let's talk about Vodafone only. Whenever they've raised money, they got more money. They've just burnt it. And again, they have come back to raise more money. And they've been, rescued a lot of times. They're still losing their subscribers. So I'm not really a fan of these kind of stocks. So I would rather look at companies which are doing very well. They're down for a reason, for a particular time. They may consolidate. Again, one example, like, just to go off the topic, like Global Spirits was one company which went to a bad 2-3 quarters. The stock corrected, became 50%. Now again, things are improving for them. You've seen investors again buying those stocks. In the last 2-3 days only, the stock has moved a lot. So, you look for opportunities in these kind of companies which are down for a particular reason, which over the period will get resolved. But you've seen companies like, Suzlon, or even with companies like, Idea, where you've seen again and again, the money comes, gets burnt. They don't know what is happening for the future. So I would rather stick to, the other companies where I feel opportunities are better.
Fair point.